Welcome to part two of lean accounting. We will go a little deeper in this session compared to the breakout that we had this morning. The beginning of this is actually almost a repeat of the breakout, so what I'd like to do is give you the chance to ask questions, because we didn't have enough time during the breakout to ask questions. So we can ask a lot of questions. We have a microphone here. Oh, that one? Okay. So we have a small crowd, so I can move the microphone around. You could ask the questions, and if you prefer to speak in Polish, give me a chance to put the translation on so that I can listen to the question. I want to have a discussion. Okay, I have slides in a presentation, but the more we talk, the more we'll learn. So we're going to review lean accounting thinking. Then, what are the actual practices that a lean company employs in terms of financial management? And then I'm going to give you a case study of a company that we've been working with in Italy for a year and a half, and they've developed the lean accounting practices. They've been using it, and I'll give you a review of what they've done thus far. And then, how do you make lean accounting work in a company? Wrap up questions. But actually, the questions don't have to wait until the end. So, we talked about lean accounting thinking or lean financial thinking this morning, and the phrase lean accounting. But before we go, how many financial people in the room? Couple. Others, operations and stuff. Okay. Even though I've been teaching and practicing and consulting on lean accounting for years, I still think the phrase lean accounting is misunderstood. Because if a non-financial person hears it, they think, oh, it's about applying lean practices in the accounting department. And even financial people think that. And it's, as I said this morning, it's more about management accounting in a lean organization. And management accounting systems are created by companies for companies. There's no external regulation on management accounting systems as there are regulations on how you report the numbers. So the ability to create it and the ability to change it and adapt it to your lean strategy is just up to the company. Finance people need to be the leaders, but it's a total company transformation. So the whole idea is we need to create that so that there is a good link between the strategy and all of the operational practices. Another way to think about lean accounting, it's the numbers behind lean. Every business runs on numbers. What are the right numbers to use inside the business to understand how lean is working and understand how you can grow the business? This is important to repeat of, lean from a financial viewpoint. That it is about growth. Primarily revenue. Lean principle number one is customer value. And there's lots of writing and lots of people talk about how lean creates value. And the translation financially is creating value generates revenue. The other important point is that this idea of creating capacity or time, because where does time show up in the financial statements? It doesn't. And so this is a new concept that needs to be put into the business when it comes to doing financial analysis and financial management. And this is one of the hardest ideas for people to understand. If you think about lean as learning, lean thinking, we're doing the same thing here. We are trying to teach people and teach the organization how to think financially about lean. And lean takes time to become very, very embedded in a company because it takes time for people to learn about lean. Same is true about lean accounting. But I believe that if you have lean thinking in place and you're beginning the lean journey, the faster you can transition to lean management accounting and have the numbers to show people what is happening, the easier it is for them to learn. I always think about lean like going to school. When we were young and we were in school learning algebra, the first day of school we didn't know algebra, but they taught us and we practiced. And the more we practiced, the better we got, and we learned, and we had more complex work, and pretty soon by the end of the year, algebra. And so lean is the same way. And if you think about this, we're trying to teach people. So what numbers do they use to learn? The economics of lean, I think, is a very important concept, an idea that needs to be communicated in the company. Because when you begin the lean transformation, there's lots of talk about Kaizen events and improvement and Hoshin. You throw all these fancy words at it. And, we're going to create single piece flow. We're going to have level scheduling, a lot of tools and practices. And then there's even the plan, do, check, act way to think, and A3 forms, and you have all these activities. Why are we doing all these activities? And that's where I think the economics of lean comes into play, in that it's a very simple way to explain why we're doing everything. What's the business reason we're doing all this? Yes, we want to serve our customers better. We want to create a competitive advantage. And like I said this morning, it's all about making money. So what does lean do financially? If we deliver the value, our revenue will grow. And I stress delivering the value. There's many, many companies that can identify the value, but can you actually deliver it? And when we talk about, in a little while, we're going to talk about performance measurements. And if you have the right measurements in place, you will know that you are creating the value before you ship the product or deliver the service. And that's the way you want people thinking, that I am doing the right thing today. We are doing the right things today to deliver that value. And then on the supply side, productivity and improvement. There's always, a lot of emphasis on cutting costs, managing costs, lowering costs. That's hard. That is difficult to do, even in a non-lean company. It's very difficult to lower your costs. So if you stop communicating that, we have to lower our costs, and communicate more about productivity and improvement, the result will be better cost management. And so if you think about the way you talk in the company, a cost is an outcome. Once the cost shows up on the financial statements, you can't change it. It's there. You can explain why it happened, but you can't change it. But you can change operating practices. You can change the way people are thinking to make better decisions to do a better job of managing costs in the future. And that's the kind of system we're trying to create. I'm going to review this again because I think it's important. This is just a very simple example of the financial power of lean. So if this is how much money a value stream makes in a month, they sell an average of $200,000. The material cost is $120,000. The production costs are $60,000. The profit's $20,000. If we make improvements and we create capacity, now we can sell 1,200, 20% more. What's the cost? What's the new profitability of those 200 units? The revenue goes up, the material cost goes up, the production costs stay the same because we have created capacity. We created more time. And you know what? You didn't have to pay any money to create that time. No cash went out the door to create that time. Now, many types of financial analysis, in terms of non-lean financial analysis, would say, oh no, there's a labor cost involved here. But no, it's not. We spend $60,000 on labor, and because the people have more time, they can produce more and sell more. And so this idea that we can increase revenue by 20%, but the leverage of lean increases profits by 80%, that has to be understood in the business. Has to be part of standard financial analysis. And I believe and strongly suggest that the senior leaders of the company and finance, they need to be the ones who say, this is what will happen. You have to believe this for it to happen. You can't wait for it to happen. You have to know that this is what will happen with the application of all the lean tools and practices. Like I said this morning, I was very, very fortunate that in my first job as a chief financial officer, this is what I experienced and saw. And so it's very easy for me to sit here and say, yeah, this is it. I believe it, it works. And, you know, if you haven't experienced it, it might be difficult. People might be skeptical. But this is really what happens. And the more that you talk to companies that have been very successful with lean for a while, and talk to them about the financial impact of what they've done or what the results have been, they'll tell you that that's what happened. They might not get that specific about a certain product, but they'll say that's generally what's happened financially. By the way, if you have a question, raise your hand. We'll get the microphone. We'll ask the question. So, lean financial thinking. Now, this is for the accounting people. It's for operational people. It's for senior managers. For anybody who does any level of financial analysis. It's about trying to solve tomorrow's problem. You can't solve yesterday's problem. You can report about it. You can explain what happened, and that is an important responsibility for accounting. Explain what happened last month. Explain what happened at the end of the year. But that isn't the only focus. So we have, and this is really difficult. I have to admit that, because we are so conditioned to think about this month-to-month cycle. Okay, we have a new month, and so how much money can we make this month? Can it be better than last month? You know, is it better than the last 3? You know, looking back 2 years, is it better than, you know, June of 2015? You know, you can do all these comparisons, but we need to train our organizational thinking more on trying to get better financially. The only way you get better financially is to really understand operations. This is not a financial exercise. When I'm talking to financial people, I tell them, you can't figure this out by sitting behind your desk and doing a spreadsheet. You have to understand what is going on physically in operations. You have to be present. You have to listen. You have to communicate and learn. Because all of the information you need to know in a lean organization, all the information you need to know from as an accountant or as a CFO is in operations. It's there. It's probably visible. It's probably being reported and talked about. So I say, get out of your office and get out on the floor. Develop relationships with operational people, and I mean real relationships. A relationship goes both ways. It's not finance saying, operations, I need this. That's not a relationship. You have to, and I speak this from experience, because in my job as a CFO, when I learned about lean and I actually put lean accounting in place, the vice president of manufacturing was my best friend. And to this day, we are still very good friends, even though we haven't worked together for 20 years. But he taught me about lean. He said, I need some help putting performance measurements in place. Can you help me? I said, yes. And then I started understanding lean. You know, they would take me out on the floor and show me what was going on. And I begin, when you see it, then I can begin to I was able to understand what all this meant. It was more than words. It was more than like theory. And that was very, very important. So whatever role you have in your business, you want finance and operations to be best friends. It's as simple as that. So we solve our operational problems, we improve our performance, and we create sustained financial improvement. Because this is a cycle, that's really the result you get. We're always improving. Lean is the strategy. It will always be the strategy. So you're always going to be looking to improve. But I don't have a slide on this. The financial impact of lean is not direct and it's not immediate. Again, how do we think in business? We think very short term, especially people who are running companies. We do this, we should see results, and we should see results very, very quickly, or else it's not working. Okay? This is just the way business thinks. Lean doesn't work that way. How long do you think it takes any size company to get good lean practices in place? 5 years? It's anywhere between 2 and 5. I mean, I helped a small local company with lean and lean accounting. And we're talking about 60 employees, and it wasn't manufacturing, it was software. 2 years. Actually, it was about 1.5 years before they really started understanding it. And the owner was very impatient. Why isn't this happening faster? I said, it takes time. These people have to learn how to do this. They have to change their thinking. We have to break bad habits. So it's important to understand, that there are, the financial benefits of lean are more long-term and what I would say indirect. So we can talk about lean accounting in terms of tools and practices, just like you can talk about lean in terms of, how do you create flow, how do you do a Kaizen event, all the how-to. But it's important for the organization to understand that this lean management accounting system is really a learning system. We want the organization to learn about lean through the use of numbers. This idea of having a strategy and operations and financial results, and how do these relationships work? And how are things going today? How do things need to perform in the future? The economics of lean. When financial management is done, some level of financial analysis, and this goes on everywhere in the organization. This is not just the accounting people doing analysis. Sales and marketing people do analysis on products and customers and the potential profitability of orders. You have operations doing decisions about purchasing machinery, and I'm going to show you some examples of all this. new products, understanding which new products are going to be profitable. You want the entire organization to really follow standard practices on analysis based on the economics of lean. And you also want consistency in thinking about the financial impact of lean, about the rate of improving flow improves profitability, measuring the impact of improvement, and how much improvement do we need in the future to achieve our long-term financial goals. So, any questions about the thinking part? Okay, so now we'll dive a little bit deeper and we'll talk more about the numbers and how do you get these numbers? What do these numbers mean? So, we're going to be talking about the value stream income statement. We're going to talk about how do we use lean performance measures to do financial analysis. How do we create these relationships? And how do we make decisions? So, I mentioned earlier this morning that value streams are the profit centers of a lean organization. So, internally, what we want to do is present profitability by value stream. So in this case, we have 3 value streams: motors, systems, and spare parts. We want to look at the operating profit of each value stream separately. We want to do this because value streams are almost like separate business units within a lean organization. They may produce and sell different products or services. They may have different customers. They may have typically have different resources dedicated to the production of those products or services. They may have different operational problems. And so when you're from a strategic viewpoint of lean, you have to think about value streams in terms of how do we manage and control the value streams. From a financial viewpoint, this is how we make money. How fast the orders flow through each value stream determines the profitability. So, actual revenue and the actual direct costs. So, this is just what the value stream can control. All of the other costs can go into support. You could also call that selling, general, and administrative expenses. And then if you have new product development, you would also have that as a separate value stream. And then, so here's the operating profit. This is what accounting has to do at month end. They have to value inventory, and in this case, in this example, this location is assigned some corporate overhead, and this is the reported profit. This is what gets reported externally. This is what is generated internally. And so the customer or the customers of the value stream income statement are the value streams and other managers. The value stream income statement is not intended to be sent out to investors or shareholders or banks or anything like that. As I mentioned this morning, we're trying to measure the flow of money. How much money came in based on how much we shipped? How much money went out based on how much we actually spent? It's as simple as that. One company that we worked with, they called this the checkbook of the value stream. It's like your personal checkbook. How much money do I have in the bank at any time? That's what this is. This is not a separate set of books. This is really just a different reporting format. All the numbers come out of the general ledger. You're just creating a different report format. Any questions on this? Now, here's how we use it. We also have lean performance measurements. And we want to use the value stream income statement and the lean performance measurements to do our root cause analysis on our profitability. Typical lean performance measurements. Talk to any lean expert about this. They'll tell you that these are the five areas of performance that are measured. Now, there's also other areas such as safety, which is measured, but we're strictly talking about the operating performance. Okay, so even though safety is not on here, I want to acknowledge that safety is very, very important. And the lean performance measurements, this combination, are really leading indicators for financial analysis. What I mean by that is that if, based on how the measure is trending, it should give you an idea of what's going to happen financially. There's an element of prediction in this. And, finance people love to predict, do the financial forecast and how well we're going to do. And this really is a very good tool. And again, from experience, when you have these measures my personal experience with these measures in place, it is easy to understand what will happen this month. Productivity. The definition of a productivity measure is increasing sales with existing resources. Sales per person, sales per hours worked. The more you get out with your existing resources. A measure of on-time delivery based on what the customer wants. So internally, you want to measure yourself against customer expectations, not against a negotiated date. How many of you have high on-time delivery because you negotiate dates with your customers? No? You meet all your customer dates? Like if somebody wants it in 3 days, you get it out to them in 3 days? Or do you say, well, we can get it to you in 7. How about that? Then what you do is you measure it against the 7 days and you're 100%. From a lean viewpoint, then you never discover problems. So internally, measure against what the customer wants, because the idea is to reveal the problems and issues preventing you from doing that. If you're in manufacturing, you want to measure your flow, the inventory days or inventory turns. What I always tell manufacturing executives that are on the lean journey, and these would be people that are not involved in day-to-day operations. I said, if you really want to know how lean is working, just look at your inventory days. If the days of inventory is coming down, lean's probably working well. If it's not coming down, then you probably need to investigate if the organization is learning and really addressing the right problems. Quality. We want to reduce defects and rework over time. And then lead time, the rate of flow through the value stream. From the time you receive an order to the time you ship or deliver a product, that you want that to shrink. So these are the basic performance measurements. Now, when you get into, and like tomorrow, we're going to talk in detail about how do you actually do the calculation. But every value stream would have these measures. And you have to take the concept of the measure, what are we trying to measure, and you have to create or define it for exactly for your business. How will we do this? So what we want to do is use these performance measures as leading financial analysis, like material cost. Okay? How much we're spending on material. Material is the only true variable cost. What I mean by that is it has a direct relationship with your revenue. If you produce and sell more, the material cost goes up. Produce and sell less, material cost goes down. So it's understanding the relationships, and we got to be very, everyone needs to understand this. This is where you get into now changing thinking again. When you're thinking about how much you spend on labor, how much you spend on machines. The relationship is based on capacity. How much capacity do we need? That is going to drive your labor and machine cost. Go back to the economics of lean about creating capacity. So improvement, the more that you improve and the more capacity you create, the better you're going to control your labor and machine costs. Because there's lots of businesses that say, oh, well, a portion of our labor is variable. But variable means it moves in direct relationship with volume. No, it's not true. Your labor cost is fixed based on how much capacity you have. If you run out of capacity, you have to buy more capacity, which means you have to hire more people. Now, this is a different way to think about labor and all your other costs. Then there might be other value stream costs, which may or may not have a direct relationship with revenue. What you want to understand is what is the root cause of every cost. So again, this is a shift in thinking from sort of traditional financial thinking about costs. I mean, there are some manufacturing companies that even say, well, a portion of our overhead is variable. No, it's not. The reason traditional financial thinking likes to take a fixed cost and make it variable is because then it appears to be easy to control. If volume goes down, if volume goes up, well, that labor cost has to go up because it varies. Likewise, if it goes down, the labor cost goes down. You know, the only way your labor cost goes down is if you have fewer employees employed. And you don't really want to do that because, like we talked about this morning, in a lean organization, your most important asset is your people. You want your people. They have knowledge. They have experience. They understand customers. You don't want to lose that knowledge. So let's dive a little deeper. Material cost. You can do there when you buy material, and in the lean accounting world, we're concerned with how much material we are buying. Because there are three outcomes. If you buy material, three outcomes. Number one is you can buy it, produce it, and ship it, right? The leading indicator, and this is a performance measurement, that if our lead time is going down, we probably will be buying more material and producing it and shipping it. So our revenue, our contribution margin will get better over time. It will be increasing. This is good. This is the outcome we want when it comes to material. The second outcome is we can buy material and scrap it. So how does operations, this is you have to sort of put your thinking hats on. How do we know that we can get better at reducing the amount of material that is scrapped? Well, we focus on the quality measure. So the quality performance measurements, we want them to improve. If they are improving, we know that scrap expense will go down. It's predictive. So from a financial viewpoint, you don't have to do much analysis on the scrap expense. Again, that's a historical, backwards-looking analysis. You want operations to be doing a lot of detailed analysis on the root causes of quality and also have plans in place to improve quality. The third outcome is you can buy material and you can put it in inventory. The leading indicator is your days of inventory measure decreasing. If days of inventory is going down, we will buy less material over time, and it will improve our cash flow. That is the predictive outcome if you see the measure going down. So it's vital that if the financial team wants to do this type of analysis, that they need to understand trends in the measures. There are connections. And you have to abandon old ways of thinking. Labor cost, every company's favorite topic. The leading indicator is productivity. If you are improving productivity, you are creating time, and you will be able to increase revenue without adding people. Now, if you have overtime, you might be reducing the overtime, because if you have a lot of waste in your process, you need more capacity, so you have people work overtime. Overtime is just temporary capacity. So if you, in the 8-hour day, if you decrease waste, there's more time in an 8-hour day, so overtime goes down. So there might be some direct cost savings there. But for the most part, you want to focus on productivity. If the productivity trend is improving at a steady rate, you can almost predict what your labor costs will be. It might not be going up that much. Likewise, if productivity takes a sudden negative turn, that might be an indication you might have to spend more money, or maybe you're going to be working some overtime. It's about available capacity, okay? When the demand when the demand is greater than the supply, when you're out of capacity, then you got to buy some. Your labor cost will go up. But, and I said this morning, this is what, again, it's about really changing thinking. It is okay to hire people and buy more capacity if you maintain your productivity trends. Because that means you're still you're increasing your capacity, but you're also increasing your output. And when I was CFO and working and we had matured from a lean viewpoint, we rarely worried about how many people we were hiring in the factory. We talked about it, we went through a process, but we always maintained our productivity. Machine cost is very similar to labor in that improving the productivity is the leading indicator. What's the financial outcome? Increasing revenue. We might achieve some direct cost savings of reducing maintenance costs, repairs, tooling, things like that. And likewise, when it comes to capital purchases, it's when we run out of available capacity. When we don't have the capacity, we have to buy it. So we have to spend the cash, we're going to increase our costs, but if the demand is there, we're also going to be increasing revenue. The primary operating reason to buy a new machine is, from a lean viewpoint, is we don't have the capacity any longer. And there is a way, we can't get into it today, we'll talk about it tomorrow, but part of lean accounting is to be able to calculate that capacity at any point in time. So this idea of value stream income statement and performance measurements, just to wrap up, we want to measure value stream profitability using actual direct costs, minimize allocations. Cost allocations are not good to use because they're very, very subjective. They confuse people. Why am I getting charged this much for whatever? And it also leads to behavior of trying to reduce the allocation. If you employ any level of a standard costing system, especially that would be primarily manufacturing, we don't want standard costing information in the value stream income statement, because standard costing is really a big cost allocation scheme, and it confuses non-financial people. We are trying to achieve operational accuracy. That's the goal of the value stream income statement. And as I mentioned this morning, I don't have this slide here, the operational accuracy is the flow, we're trying to measure the flow of money. And finally, we're talking about internal use only. So, any questions? Okay. So now let's talk about this whole financial management piece of making business decisions and doing the analysis. We talked about performance measurements. We talked about capacity. We talked about a value stream income statement. So we put these three sets of data together in what we call in the lean accounting world the box score. So it's having these numbers and understanding the dynamic relationships between these numbers when we're doing an analysis. And this forms the core of a lean of financial management in a lean company. And I'm going to show you a lot of examples here. So here's one example. The impact of improvement. And lots of company executives want to know, well, if you're going to do all these Kaizen events, what's the financial benefit? Or they might say, how much are my costs going to go down? And that's where you really do have to correct them. Even though they may be the executives of the company, you do have to correct them and say, your costs are not going to go down. I'm sorry. But if you can, that's why you got to explain that's why explaining the economics of lean is very important, because the impact, and this shows you, here's what happened here. We improved on time. We have 3 Kaizen events planned. We improved on-time delivery. We reduced inventory. We're going to reduce inventory. We're going to improve quality. What's the primary impact? The primary impact is we are creating 20% available capacity. See, and this is what happens, is that when you do operational improvement, this is waste. This goes away and becomes available. And it can be measured. Yes, we have some direct cost savings. We're saving about $23,000 in material a month. Why? Because our inventory, we're buying less, because our inventory is going down and our quality is going up. So there is some direct cost savings. Then there's some miscellaneous costs here. But the true financial impact is what you do with the capacity. Okay? So operations, we have 3 events planned. We're going to create 20% capacity. We're going to save $25,000 a month. But there's still more opportunity here to use that capacity in something else. Okay? Let me show you an example. So again, we have current state, future state. We make some improvements in delivery, in quality, and in inventory, and we almost double our available capacity. How about in terms of profitability? Not much change, a little bit of improvement, and again, it's on the material side because we improve quality, reduce inventory, so we don't buy as much. When you decide what you're going to do with that capacity, that will be the true final analysis. So in this case, we can take all this capacity we created, and there's opportunities to sell more. So here's the new revenue, which is almost $100,000 higher. The material cost goes up. Our labor cost stays the same because we had the capacity. So how much money will we make? We'll make $170, almost $173, not $107. We're going to make a return of 40%. Oh, and by the way, look at how much cash flow improves. Okay? So I always call this like a two-step financial analysis. One is, what is the direct impact? Remember I said earlier, the financial benefits of lean are not direct and immediate. And this is one example. Yes, we have some money we're saving here, but we're creating capacity, and when you decide what you're going to do with that capacity, that gives you the true financial impact. Oh, question, yes.
Yes, hello, my name is Nils. And I'm just wondering if the possibility for using that free capacity is not there. And I guess you have been in that situation a few times with different clients and discussing with CEOs. So what do they say, and what do you say to them?
Yeah. Well, this is where when I was talking about this yesterday in the open discussion, if you adopt a lean strategy, it's very important to understand all of these concepts we're talking about, the eliminate waste and increase capacity. Now, it doesn't happen overnight. It takes time. But this is where, from a strategic standpoint, you have to get sales and marketing engaged early and saying, you know, we're going to be creating available capacity, so we need more sales opportunities. The other thing you have to do is look, if you're in manufacturing, for example, is you have to look at new product development, because you would want that lead time to shrink so you get the products faster into the marketplace to use that available capacity. Because if you're creating capacity, you know, if you're just here, operationally, you've done a good job. Costs nothing much has changed. Now, this is what typically happens early in lean, and if people just focus on the bottom line, they say lean's not working. You don't really want to eliminate that capacity. Yes, that you would cut your costs here, but what's the danger? Right. Nobody will want to do improvement anymore.
Exactly.
Yeah.
Exactly the point.
So, but you have to talk about this at the leadership level. There has to be clear understanding of how lean works. And if you don't think of it the right way, if you think lean is about cost cutting, or lean is not all comprehensive, or lean is just on the shop floor, you're going to miss. But if this is why training and education is important. And that's one of the things that I learned as a CFO, is that we as a management team, we thought the same way. We understood how lean worked. We did not dispute it. But here's the other thing. You know, when sales knows that available capacity is going to be created, they have more opportunities to sell, because they don't have to cover these artificial costs, which aren't really going up. Now, I'm not saying they're going to lower prices, but you can take business in. In fact, I was working at a company a few weeks ago, and I was explaining these concepts, and so the owner said to me, And this is a fast-growing business. So the owner said to me, so if I'm sitting there talking to a customer and they want a 10% lower price and I have the capacity, I should take that order. I said, yeah, you're flowing it through. Now you don't want, I said, the only danger there is, will that customer talk to the other customers, you know? But, and he said, no, there's no worry about that because it's a negotiated contract. So again, if you're looking at adding new products, so if we're going to add some new products, which increases the revenue and increases the material cost, what's the impact on capacity? Well, we don't have enough capacity, so we have to buy more capacity. So that's why our labor cost goes up and our machine cost goes up, but we're still making good money. And I will say from experience, when you create a real box score for your company and you start doing the financial analysis using the box score, the majority of people believe it. They don't dispute it, especially the lean people. They always say, that's what I've been trying to explain, but I've never had numbers. So you can use box scores when you're doing value stream mapping. You can do box scores to look at value stream performance on a weekly basis. For all kinds, I gave you a few business decisions. Just about every business decision can be analyzed through a box score. All continuous improvement, whether it's the Kaizen plan or one event, you can use the box score. You can use it for annual planning and strategic planning, and capital purchases, projects, acquisitions. Any questions? So let's look at Zopas. And I'm going to check the time. We got about 10 minutes. Oh, yes. Hold on, they want to be able to translate.
What about project management? Because it is something like new product development.
Yeah, you can employ box scores for projects or product development. There may not be revenue associated with it, but you can understand the capacity and you can understand the costs and the performance. And it's a very powerful tool. Yes, and I've put box scores in place in product development and project management. You just have to understand what the measures are. Okay, did that answer your question? No.
In new product development, it's new product, but in project management, sometimes we have, for example, a new capability and IT solutions.
Yeah.
What about that?
Yeah, well, for an individual project, you probably don't want to use a box score, but you want to make sure that that project is flowing. So you would want to have, for example, daily measures. You know, did we achieve the schedule for today, and understand it from a more of a flow point of view? Because until the project gets done, there's really nothing associated with it. And so you can do individual projects are better. It's best to try to measure flow, schedule attainment, quality, and defects. Now, the project
in flow, we are trying to measure something like business solution. Business solution is process, organization, information, technology. Mm-hmm. It combined in one business solution, and we are trying to do lean in IT projects.
Yeah.
And this is a part of flow, not all whole project, only on these solutions.
So it's is this a solution for a customer? Is that what it is, or is it internal?
For example, monitoring temperature in transport.
Repeat that one again.
This is
Oh, monitoring temperature and
an
transport.
example of this solution.
Yeah. Okay, so that sounds like some level of an improvement event, right? Is that really what this is? You're trying to improve a process? Is that true? Is that a good way to think about it?
Because in projects we have always different products.
Okay. Okay.
Project products, not in
Are
new
these-
product development. We have new product on the market.
Okay.
In project we have some solutions.
So is it a solution for one customer or
It's
many?
hard to track these solutions, and we are trying to track this solution level not on the level of a whole project,
Yeah.
and connect with these solutions with costs
Okay.
and flow, cost and flow.
Okay. So yeah, okay.
To know what is inside.
Yes. So the flow, I think, I agree with that. That's what I was explaining earlier. The cost of the project, I don't know. You know, that you might have some direct costs, but are you trying to assign labor to the project, to how much time people spend on each project?
Yes, we are trying
Oh,
to,
see, that you don't want to do that.
but not for project, for solution. Because solution
Yeah.
is a business solution, is something
Right.
working. And
Right.
product is part of product. Product on the market is something different on some products in project management.
Okay.
Then
So
we are trying to track producing the solution, business
okay.
solution.
Okay. So you have a business process that creates these solutions, right?
Yes, but process is repeating.
The
And in
yes,
product
the
you have-
process is repeating.
Yes.
That's my
it's
point.
something like tailor-made solutions.
Right. And so you have different projects which flow through the process. Is that an easy way to think about it? That creates solutions?
Yes, but problem is that they are not similar.
I understand that. Right, that's right. I'm right. But they flow through the same process.
Yes, but the flow
Right.
is the same.
So right here, you can do a box score for the process as a whole, right? For each solution, that's where you want to apply lean practices and do the flow.
Flow and cost.
And yes, some level of cost, a direct cost, yes, but
And
I don't think,
productivity for each stage connected with standardization of the stages.
but why do you have to track the cost?
To allocate cost of PMO, people from business, people from IT,
Right.
to this solution in project, not for
Right.
whole project. Because
understand.
if you have whole projects, for example, customer relationship management, it takes 2 years to deliver, and inside you have many solutions.
Right.
Then we are trying to track the solutions and cost
Right.
of this.
So why do you have to track the cost?
Because a lead time of these solutions is very long, and the cost of change management organization is big.
Yeah. And what did I
Too
didn't-
expensive and too long.
Right. Well, what did I say this morning about time and costs? Do you remember?
Yes.
No. the amount of time that it takes something to go through a process does not impact cost. Time and cost are not related. Just because one project takes longer than another doesn't raise the cost of the business. So when you think about cost, you have to think about the cost of the business. The question is, why does project A take longer than project B? It could be because project A is more complex and requires more value-added time. Or it could be project A, there's a lot of waste in the process in project A. So that's where lean works in terms of time. When you're dealing with something that is custom made, your cycle time, which is the actual productive time, is not always predictable, nor is it the same. That's the whole idea of customization. I have to spend more time to make something more complex to meet your need. That doesn't raise my cost of the business, though, unless I had to go out and hire 5 more people to work on that project. It's a different way to think.
Okay, I'm sorry, but I'm afraid we already run out of time.
Okay, that's fine. That's fine. There's a case study. I guess the presentation is available. It's just interesting what they've done, and I'm just going to go. Let me just go to the end. That's how you can contact me. If you don't get if you would like a copy of the presentation, I'll be glad to send one to you. Just send me an email. And if you have any questions at any point, please feel free to email me. Go to our website. I actually have some business cards here if you want to take them. So thank you for your time, and thank you for your participation.